Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Global stocks hover near record highs. With Asian equities drifting, investors look to key US data this week for clues on the Fed's rate path. Turning Point VW considers its first ever factory closures in Germany in an effort to cut costs. That's as Europe's car industry struggles. And Israeli Prime Minister Benjamin Netanyahu asks for forgiveness over the deaths of hostages, but pushes back against a new wave of pressure for a ceasefire deal in Gaza. So a modest risk-off mood then filtering through these global markets, waiting for that key US data. The manufacturing gauge, PMI, crossing later today, expected to be in contractionary territory for the second straight month. That ahead, of course, of non-farm payrolls that drop on Friday. And prior to that, more data around the jobs market of the US. The US reopening, of course, today after the labour market holiday of yesterday, the Labour Day holiday. European futures pointed flat right now. FTSE 100 futures also in similar territory. S&P futures pointing lower by about 0.1%, but again, still near those record highs. JP Morgan warning that even if you do get a cut, and that is expected, of course, from the Fed on September the 18th, then even then, this rally may stall out. That's the view from JP Morgan's strategist. Nasdaq futures pointing lower by 0.3%. Let's flip the board and look cross-asset then. Oil in focus, Libya announcing force majeure. Output challenges around that oil exporter. Oil and Brent currently trading at $77 a barrel, down 0.4%. The US 2-year, as we look ahead to the data story evolving out of the US through this week, 392 on the 2-year at the front end. The euro at 110. A little bit of pressure coming through on the single currency after the gains of yesterday, down 0.1%. More to do with dollar strength in the session, really, than euro weakness. And on iron ore, the sell-off continues around that key commodity and input, $94 per tonne when it comes to iron ore, down 2.2% after a drop of around 4% yesterday. So look again at the basic resources sector at the open this Tuesday. Let's check in, though, on how Asian markets are faring this Tuesday morning. Cross over to Avril Hong, standing by in Singapore. Avril.
Yeah, Tom, we're actually not seeing a whole lot going on this part of the world because we're keeping an eye at the end of the week for the US jobs data and in the meantime for US markets to reopen after the long holiday. So we're seeing thinner than usual trading volumes, particularly on the Nikkei. Not a lot of trading, but the Chinese equities are moving sideways more or less after the steep sell-off just a day ago that was triggered by the data over the weekend showing those cracks really continuing on the manufacturing sector. I also wanted to highlight in terms of sectors that we're watching, we're seeing the chip stocks continuing the declines from a day ago, but the financial names in Japan are among the big gainers as we see higher yields. Let's flip the board because to your point about what we're seeing in iron ore futures, as they decline, they're actually dragging the Aussie dollar along with it. This is the worst performing G10 currency today. We're seeing it losing ground by the most since June. And among FX, the one currency that is gaining in this part of the world is the Japanese currency. Of course, the debate continues. Where does the yen go from here? At the heart of that debate is the extent in which we're going to see the narrowing yield differentials. And IM Life strategist Mark Cranfield raises the point that either way, what we get out of the jobs report on Friday, the yen could win. Say we get a bad jobs picture and aggressive easing bets, we see the weak dollar strengthen the yen. If we see an okay jobs picture, that could disappoint equities traders and prompt some safe haven demand for the Japanese currency. So either way, maybe what we see today on the strengthening of the Japanese currency is potentially going to continue. Some of the dynamics to keep in mind this part of the world. Tom.
Yeah, and PIMCO suggesting that the next hike from the BOJ could come in January of next year. Avril Hong with the check on the Asian markets for us, joining us out of Singapore. Avril, thank you as ever. Let's turn our attention right now to the Middle East, though, where thousands of Israelis took to the streets in labour strikes and protests yesterday, the strongest push yet, to force Benjamin Netanyahu's government to agree to a ceasefire with Hamas and secure the release of hostages still held in Gaza. Despite rising anger, though, the Israeli Prime Minister is, for now at least, standing firm on ceasefire terms.
We say yes, they say no all the time, but they also murdered these people. And now we need maximum pressure on Hamas. I don't believe that either President Biden or anyone serious about achieving peace and achieving the release would seriously ask Israel to make these concessions. We've already made them.
OK, at this point, let's bring in our EMEA news director, Ros Matteson, for the latest. So, Ros, the pressure mounting, but a defiant Prime Minister, at least in that commentary from Netanyahu, not suggesting that he's changing or wavering or changing tack. But behind the scenes, is that pressure paying off? Is it moving the dial in any way?
Well, it doesn't seem to be. As you say, we got pressure from the US particularly. We had, Joe Biden again saying that he thinks that Benjamin Netanyahu could do more to get Israel towards that ceasefire with Hamas over Gaza. But equally, you see, Benjamin, quite unusual apology for Benjamin Netanyahu. He did actually apologise to the families of these hostages who were shot recently, the 6 of them. He apologised directly to them with a big however. The however was, I'm doing what is necessary to protect Israel. His view is if you allow some of these concessions to get the ceasefire, then you risk Hamas being able to regroup, rearm and come back again potentially directly to Israel. And so his point is he feels he can't move any further. He also wants the option still to allow fighting to resume, this to be a temporary ceasefire and not a proper pathway to the end of the war. So that's his viewpoint. It's very hard to see how he can shift on that. He's very much bound in by the right in Israel. He's aligned himself very much to the right to stay in power over the past year or so. So he's stuck on that front. And we've seen the US pressure, frankly, before. We've seen Joe Biden say repeatedly, directly to the point that they were kind of fighting publicly over it, and it's not done anything. So the question is, what is actually going to move the needle here?
And the US have not halted arms sales to Israel. The UK, though, has at least some elements of arms shipments, and that news crossed yesterday. Was that a surprise? What is the thinking behind this? Is the UK trying to leverage pressure on Israel? What's determined this decision?
It's probably a reflection of the fact we've had a change of government here and we've now got a Labour administration. In a way, it matters more politically than militarily. The UK government doesn't ship weapons to Israel directly. It allows companies to do so, and it's very, very small. It is some key components for things like F-35 for aircraft and so on. And so it's going to be a very small military impact for Israel, but it's quite symbolic that the UK has now done this. You can see there's criticism already of the UK from Israel and from the Israeli community as a result, and differentiating themselves from the US, where Kamala Harris, the Democratic nominee, has said that she wouldn't do the same thing. So it's interesting to see the Labour government in the UK putting itself out there and perhaps signalling a different kind of relationship with Israel. I mean, the UK is a strong ally and supporter of Israel in all of this, but certainly raising some questions about where the war in Gaza is going.
OK, Ros Matteson, our EMEA news director, thank you very much indeed on the latest, of course, out of the Middle East and that decision by the UK to halt at least some shipments of arms, or at least components, to the Israeli military. Now to the oil space, and oil is a little steady after concerns over China's economic outlook offset supply disruptions in Libya. The state oil firm in that country declaring force majeure in Libya on a key field in the country's east. That's widening a production shutdown triggered by a power struggle between rival governments. Our Middle East energy reporter Anthony Di Paola joins me with the latest. Anthony, what do we know about the shutdown then in Libya and the impact?
Good morning, Tom. Yeah, that's a major field for Libya. That's the El Feel field, also known as Elephant. So giving you kind of an idea of the importance in the local market and in the export markets there. That's a big field that the national oil companies declared force majeure on, meaning that they won't have to make those shipments to buyers. We've seen some shipments continuing over the weekend from some of the ports there in Libya, but with the amount of crude available and the amount of crude in storage dwindling, as these shutdowns kind of cycle through the market, we have seen the eastern government initially declaring force majeure, and then orders going into some fields even to restart over the weekend, mainly, we think, for domestic use and for refining. But that does bring some oil back into the market. But the real picture there is one of uncertainty, that we're not sure again, which fields are going up, which fields are coming down, trying to find out still the actual level of production. Libya does about 1 million barrels a day normally. We're probably down to at least half of that, according to some of our reporting over the weekend. And we'll be seeing how that develops. And again, the uncertainty for the market about how long this potential disruption will last, Tom.
Okay, so we look at the disruption side and we continue to monitor the developments in Libya. Meanwhile, the question about China and Chinese demand with the softer economic data, and we saw that play out in the markets to some extent yesterday, Anthony. Where do we stand on that front? What is the latest in terms of the demand impulse from China and the outlook in the weeks and months ahead?
Yeah, the market is concerned about that because we're seeing focus on the construction market there in China and whether that's going to reduce demand for a lot of energy. And we're seeing also some additional refinery startups there, and that's going to potentially push more refined product into the rest of Asia. And so the market is really watching what is going to happen there in China. They do have export quotas for the refineries, which they need to see if they'll be able to fully use those, and that will have an impact on the margins for other refineries and then therefore the demand in Asia. So really what happens in China does have an impact on the wider market and then feeds back through into here, into the Middle East in terms of production decisions. Now, we also know that OPEC Plus is supposed to go ahead with plans to add some barrels back into the market starting from October. These are some of the voluntary cuts that some members made, and that follows on a decision made in June to do so. So they'll be keenly watching the market here, watching that Chinese issue in terms of demand there, the Libyan disruption, as well as a lot of non-OPEC supply coming on from the U.S. and other countries in the Americas, Tom.
Okay, Bloomberg's Middle East energy reporter Anthony D. Powler in Dubai with an update there on some of the key factors feeding through to these energy markets. Anthony, thank you very much indeed, with a lens still on China, but also the disruption to some of the exports out of Libya. Here's what else we'll be thinking about today then. 7:30 a.m. UK time. We're going to get the August inflation print, CPI out of Switzerland, expected to cool at least around the edges. It could lead to further expectations around a September cut in terms of interest rates from the Central Bank, of course, of Switzerland. So we watch that data point later today. 10:30 a.m. UK time, South African second quarter GDP print will be coming out. So a gauge there in terms of the key emerging markets and the growth picture on that front. And at 3 p.m. UK time, the big one in terms of the data front, particularly for the US, the ISM manufacturing print. Expectations that you're going to get a second straight month of contraction when it comes to manufacturing. We'll also be looking at the components within that data set, new orders, the hiring picture as well, and to what extent that will factor in to thinking from the Federal Reserve around a cooling US economy, if indeed that is what comes to pass. You can get a roundup, of course, of the stories you need to know as well to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go on the terminal. A couple of top stories coming through. One is the call from T. Rowe Price sounding the alarm on yen volatility, saying that it is not yet done. And of course, the role of the Fed important in that conversation. Cathay, meanwhile, scrapping flights on some of its inspections around some of its planes as well, particularly between Hong Kong and Singapore. So continue to monitor that story around problems around some of the Rolls-Royce engines. And Kamala Harris, of course, the presidential pick for the Democrats, saying she wants US steel to be domestically produced, so posing another production problem or potential problem around Nippon Steel's bid for that key asset. Kamala Harris weighing in with her views yesterday. Today's Bloomberg big take, by the way, focusing on Volkswagen as it weighs closing factories in Germany, a first in its 87-year history. We're going to be drilling into that and European car makers' struggles in the face of red-hot competition from Chinese rivals. Coming up next, though, India's Nifty 50 has been rallying for 13 consecutive days, but it is about to hit the brakes. We will analyse the numbers and get a view on India's markets. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak. Happy Tuesday. Let's turn our attention to India right now. The Nifty 50 has been on a record bull run recently. Year to date, by the way, it's up about 16%. Let's bring in at this point then Tanvi Kanchan, who's the head of UAE Business and Strategy at Anand. Rathi shares always smart on these Indian markets. Tanvi, thanks for joining us. Does the bull run in Indian stocks have further to run, or are we looking at a pullback at this point?
Hi, Tom. Thank you again for having me here. So a lot of people are actually asking the same question because Indian markets are somewhere, outperforming not only its emerging market peers, but also the global market peers. You're looking at Indian markets having an outperformance in the short term, long term, and even at the 20-year average. If you look at a dollar return, Indian markets have somewhere delivered an 8.9% of dollar return in the last 20 years, followed by US economy at 7.6%. So there has been that level of consistency. However, looking at short term, we are looking at multiple different level of risk. There is obviously the hovering US Fed rate risk that's there, followed by what the RBI would do because the GDP numbers have also been below expectations for RBI. So we are also looking at certain level of like a dovish stance from RBI, followed by a certain level of contraction in their monetary policy stance as well. Whereas in the Indian equity markets, it has primarily been driven by private consumption. So taking the risk factor in place, taking the Indian markets in place, and also the kind of inflow that we are looking at from FII, FPI, there is a level of better performance that we are expecting.
OK, and we want to get your views on those flows, particularly in light of the expected cut from the Fed. But before I get to that point, the question that always comes up when it comes to Indian equities, or at least always within the recent time frame, is the question of valuations, Tanvi. And this is a question I put to you last time. But valuations right now, benchmark price to earnings ratio is above 23 times. That's well over the long-term historical averages for Indian equities. Is that a challenge to the run-up that we've seen so far, or at least a challenge going forward?
I do believe that we are somewhere overvalued. Now, Tom, if you look at us in comparison to even the emerging markets, we are overvalued at 2x, 3x in comparison to certain economy. However, if you take a broader index, that is, if you take Nifty 50 and you take a 5-year, 10-year current long-term average current 10-year data in comparison to long-term average data, and you take 2006 as a base, your current averages are at about 12.1, and long-term 10-year averages stand at 10.4. So in perspective term, the variance is just about 1.7%. Similarly, for mid and small cap indices as well, we're standing at a variance of about 4.8%, 4.9%. So valuation in specific sectors is more than the long-term average. However, when you do a deep dive on broader level indices, on a broader level market, we're somewhere still in line with your long-term averages. As you mentioned, 20 is not that high of a number for Indian markets.
Tanvi, what's your sector preference at this point then?
On a broader level, honestly, Tom, we are also looking at FIIs, FPI inflows in sectors such as power, telecommunication. At our level, we are very positive on manufacturing, on industrial goods, on cement, on automobile, even on FMCG. So these are the major drivers that we are looking at. If you look at the last quarter data, the best performing indices were auto ancillary at 27.4% in terms of year-on-year PAT growth, followed by financials at 25%. So these are the sectors that are also the key drivers for the Indian markets at a broader level.
What kind of catalyst do you think a Fed cut on September the 18th would be for EM flows into India?
We are looking at certain level of shock factor. All eyes are on the Fed, rate cut, and there are expectations that are already building up. So we do expect a certain level of knee-jerk reaction. However, the good factor is that there is a very good, healthy build-up by the DIIs. So you're already looking at $2.5 billion that's coming in consistently by way of systematic investments in Indian markets. With the inclusion of JP Morgan Bond Index, we are expecting good, consistent inflows even on the debt side of the market. So again, positive inflows on the long term, but yes, there are a certain level of shock or a certain level of volatility that we are expecting Indian markets to kind of have, also because of the rally that it has witnessed.
OK, so brace for a bit of volatility and maybe some increased inflows as well into India on the back of that expected Fed cut that is viewed, of course, around September the 18th. And the story around a constructive view on Indian equities from Tanvi, Kanchan, from Anand, Rathi shares with the insights there. Tanvi, thank you very much indeed. With the Nifty 50 just flat so far in the session, but up around 16%, 16% year to date. Coming up, Aston Martin puts its foot on the accelerator as it launches its new car and attempts to hire Formula One's game changer. Our interview with the executive chairman is next. This is Bloomberg. Welcome back. Switching gears right now and focusing on Aston Martin's new car, the Vanquish. It's just been launched and was the centre of attention at the Venetian Lagoon during the Venice International Film Festival. I spoke to executive chairman of the company, Lawrence Stroll, about how crucial the car will be for Aston Martin and his ambitions for Formula One.
The demand's going to come from our long waiting list Aston Martin customers. We have a long history of making wonderful V12 engines. This is our newest and latest, greatest made in-house. But we have a long following of Aston Martin customers for our V12 engines and have for many, many decades. We've already shown the car to several customers with great enthusiasm.
And the expected demand, I mean, is there any expectation from you and the team that you're going to be going above that 1,000 a year? Why keep the production so limited at this point?
It is our flagship vehicle. We have history and data from our previous flagship vehicle. So before the Vanquish, our last flagship was called a DBS. We were selling approximately that amount of volumes, approximately 1,000 a year for several years. That's the right amount of demand and supply. You know, these cars are made to order. They're all built by hand. So we know from history that that's about what our demand will look like. And we don't want it to be more than that. You know, this is a very, very special car. And 1,000 a year is the right number, as history shows us.
You have a new CEO, of course, leading the business, Adrian Hallmark. Some analysts have questioned the near-term targets of the business. Does Adrian stick to those targets, Lawrence, or is this an opportunity to revise those targets for Aston Martin?
No, Adrian's done plenty of due diligence before he came in. I'll let him get his feet under the desk before I answer that. But basically the answer is he does believe in the targets. We are on a plan. He's bought into that plan, and we'll be helping to deliver that plan.
Lawrence, is Adrian Newey going to be joining the team?
I certainly hope so. Adrian and I have been talking not only for months, but actually for years. Adrian is clearly the most talented and gifted individual in Formula One based on his track record and history, in addition to being a hell of a gentleman. So I'd be very excited for Adrian to join our team, as I think every other Formula One team on the grid would feel exactly the same. And
we can assume then that you're pulling out all the stops, Lawrence, to ensure that Adrian does join Aston Martin Formula One.
You can definitely assume that.
OK, Aston Martin Executive Chairman Lawrence Stroll speaking to me from Venice. Switching focus right now to live pictures coming out of Mongolia's capital, Ulaanbaatar, where the Russian President Vladimir Putin, as you can see, is meeting with his Mongolian counterpart. And you can see they put on the display right there in the Mongolian capital. This is a trip that Putin ensured that he would not be arrested by the Mongolian authorities who are signatories to the International Criminal Court. There is, of course, that international arrest warrant out for President Putin. He had received that assurance, of course, and you can see he's been given a warm welcome in the Mongolian capital. Plenty more coming up, including a look at French politics. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Global stocks hover near record highs with Asian equities drifting. Investors look to key US data this week for clues on the Fed's rate path. Turning point, VW considered its first ever factory closures in Germany in an effort to cut costs as Europe's car industry struggles. And Israeli Prime Minister Benjamin Netanyahu asks for forgiveness over the deaths of hostages, but pushes back against a new wave of pressure for a ceasefire deal in Gaza. We keep an eye, of course, on the events unfolding in the Middle East. We check in on the markets right now, though, because European futures are pointing modestly higher, up 0.1% after the soft weakness that came through yesterday. Bit of a holding pattern coming through for global equities ahead of that key US data, with the eye, of course, on non-farm manufacturing, non-farm payrolls, I should say, on Friday. Before we get there, we get the manufacturing data out of the US later today, which could give us a gauge in terms of the health of that economy and feed into expectations, feeding to the deliberations, of course, of the FOMC and the Federal Reserve, of course, as expectations build that there will be that rate cut come September the 18th. European futures then pointing very modestly high, just by a shy of 0.1%. FTSE 100 futures pointing up by 13 points, a little over 0.1% right now. S&P futures, though, lower by 1/10. The US markets coming back, of course, reopening after that Labor Day holiday yesterday. Nasdaq futures pointing lower by 0.3%. On a cross-asset basis, the focus on the Japanese yen's coming through with strength after 4 sessions of weakness for the Japanese currency. And the euro dollar, a little softer on the single currency after strength that came through yesterday, down close to 0.2%. A little bit of dollar strength coming through in the session. 3.92 on the US 2-year, a move of just 1 basis point in terms of yields. Brent at $77 a barrel, down 0.3%. You have some production challenges coming out of Libya, declaring force majeure at one of its key oil fields, and $94 a tonne on iron ore. Further softness in that key commodity, down 2.3% after the weakness of yesterday. So we look again to the basic resources sector. Concerns about demand out of China. Some breaking lines right now in terms of the corporate space, focused on airlines, with Cathay Pacific in focus, with some disruptions there to some of their planes. Inspections being carried out around the Airbus A350 that are used by Cathay, and we know that flights between Hong Kong and Singapore have been infected. The latest lines crossing then in terms of the inspections, it seems to be revealing that engineers have been checking fuel lines, suspected to be the reason why Cathay has cancelled these multiple Airbus A350 flights for what are fleet-wide precautionary checks. That's according to 2 people familiar with the matter. The airline has asked engineers to make specific checks to the flexible hoses supplying fuel to the engine for abnormalities, deformation, kinks, or degradation. That's according to the people who, of course, have asked not to be identified. Cathay not commenting at this point, but this is a story that continues to evolve, and the issue around supply chains, of course, for these aircraft makers has been one that has been prominent in recent months. This now evolving Cathay and its inspections of A350s, halting some of their flights between Hong Kong and Singapore. We could cross that story for you as you see the price right now. That's a year-to-date picture on Cathay, down 2.3% year-to-date. Now, today's Bloomberg Big Take digs into Volkswagen's historic move. So we're moving from airlines to the auto sector. This is a historic move being considered, of course, by VW to shutter factories in Germany for the first time in its 87-year history. This is EU car makers lose ground to Chinese manufacturers in the race to produce electric vehicles. Let's get more with Bloomberg's EMEA Autos industry team leader, Elizabeth Berman, who covers all this for us. Elizabeth, what does this news say then about the state of the car industry in Europe and how perilous that situation is right now?
Yeah, I would say that for the past months, really since late last year, I would say there's been a growing sense of things derailing somewhat in the European car industry, led by the slump in EV sales as certain governments removed incentives. And as things didn't quite pan out as thought in terms of the strategies laid down, and of course very costly strategies at that, these sorts of issues have been coming to the fore. Among those, VW is probably, as Europe's biggest car maker, the one that has the most work to do. And as we pointed out in our story yesterday and today as well, the company has a very particular governance setup that makes pushing through big changes, big decisions, big savings really, really hard.
And on that point then, given the ownership structure and given the role of unions and the seats that they have on the board, how challenging will it be for VW essentially to cut down or shut down those plants? How realistic is that threat right now?
Well, if history is a guide, you'd probably say not very. Lots of key top-level executives have had to vacate their seats over plans like this. So CEO Oliver Blume will be in a tough spot for the next few months. That said, even as VW continues to rake in significant profits, last year they made more than 22 billion in operating profit. They do recognize that the competition is growing in a way that they do need to make really significant changes. And one of the key issues is the overcapacity that they have, particularly in high-cost countries. Globally, the car maker has capacity to make 14 million vehicles annually. Last year they made 9 million. That's globally, of course. But the plants at risk, most at risk, would be in the high-cost areas of Western Europe. And of course, that's where VW has most of its plants in Germany, which is among those particularly high cost.
OK, Bloomberg's Amir Autos Industry Team Leader Elizabeth Berman with the latest in terms of what could be historic closures of some plants in Germany, with all the caveats, of course, but a reminder of the challenges that industry and that sector faces, not just in Germany, but across Europe, of course. You can read more on this big take. Really worth diving into this. That story on our website and on the Bloomberg terminal. Now to France, where President Emmanuel Macron has met with ex-socialist Premier Bernard Cazeneuve and Conservative politician Xavier Bertrand. This as he looks to finally name a Prime Minister in an effort to end weeks, of course, of uncertainty over the country's next government. Joining me now for a market view on the politics of France is Kevin Thozet, Portfolio Advisor at Carmignac Gestion. Kevin, thanks for joining us. Does the risk premium baked into French assets at this point become unwound when and if we get that Prime Minister named?
Well, I'm not too sure about this, to be honest, Tom. Clearly, when we're looking at the French spreads versus German Bund, they have gone up, and they have gone up significantly since last June elections, moving from 40 basis points to 70 basis points or so. Clearly, the sequence ahead is not that one should be able to tame this upward pressures on spreads. Why that is? Well, in fact, we still don't have a government. The day we will get this government, we are not really convinced of how stable it will be, given the the no majority. So we need to find a prime minister which is kind of no confidence vote proof, and that's a very hard challenge, as we can see. When it's the case, what's the stability? And he'll have to be working on the budget, and clearly to be responding to this excessive deficit procedure. So very tough job ahead for the guy or the woman in charge.
Kevin, do the markets have a preferred candidate at this point, given what you've just unveiled for us, or at least laid out for us?
Well, I think that extreme scenarios have been kind of pushed back. Again, no clear majority in France, hence this movement on the spreads we've seen. Had we had a stronger majority or a clear winner on the left side or the right side of the political chess, those spreads would have gone much higher than this, I reckon. But this kind of status quo is probably the kind of the less bad option in the aftermath of those elections. Clearly, what will be key is stability and stability of the government. It's been 2 months where we haven't had any governments in France. Spreads have remained stable, but there are several deadlines coming up, and notably the budget, which will have to go to the European semester.
Yeah, indeed. Look, Kevin, you talked about the spreads, and we've got a spread, about 70 basis points in terms of the yields of French debt OATs 10-year over their German equivalents. It sounds to me, from what you're saying, that you think that spread is kind of the new normal right now for French debt, at least in the short to medium term. Is that the right take from your assessment?
Yes, clearly is. I mean, when we're looking at the deficits in France, they're clearly they're massive, somewhere between 5.5 to 4.5, depending if I'm looking at 2023 or 2024 expected deficits. That's huge. And is this warranting spreads at 40 basis points like we had before the election? Clearly not. The reason for this stability in spreads or low level of spreads was the fact that France was part of kind of, the European engine. And in the aftermath of the elections, so let's say with so-called populist party gaining ground, this again is not a given anymore. So if I were to put it in one sentence, so-called populism has gained ground in France, and that's not positive for the spreads.
So, Kevin, with all the caveats around not knowing who the next Prime Minister will be, what are markets going to be looking for when it comes to the budget? Because there isn't a time frame, a fixed time frame as to when Macron has to appoint a Prime Minister, but the countdown to the budget decision is forcing something of a push around this. What are markets looking for from that budget?
So, I mean, what has to be baked in is 0.4, 0.5% of austerity baked into that budget. That's a tough one, and Mr. Macron has to kind of, square a circle there. On the one hand, because whoever will be appointed will be pushing for, I'd say, more fiscal spending, and will be pushing for fiscal spending. The questions around the pension reforms, which, as such, is the equivalent amount, more or less, of what needs to be saved. So, let alone if those pension reforms are again being pushed back. So that's what we're looking for, 0.4, 0.5%. Having said this, there are, I would say, second round effects, because most likely, if a government is pushing for some form of fiscal austerity, there are second round effects. There will be potentially more at play and more required. So in fact, this 0.5 of austerity could well become 1% of austerity.
OK, Kevin Thozet, portfolio advisor at Carmignac Gestion. Really smart analysis and context around the evolving politics still of France. We await, of course, for that Prime Minister nomination from Macron and Pic, and we'll see how sustainable that government will be. The implications, of course, for French assets. Kevin, thank you for the analysis. Coming up, where to invest beyond big tech. We're going to discuss the opportunities next with James Mills O'Brien from investment firm Abdrn on that particular view. Stay with us. This is Bloomberg. Welcome back. Now, the launch of ChatGPT, of course, less than 2 years ago, sparked an AI frenzy that fueled talk of a fourth industrial revolution. Silicon Valley names grab, of course, much of the attention, to say the least, but some of the biggest changes are happening on the ground in Taiwan, of course. Our tech reporter, Anand has more.
Taiwan is the home of our treasured partners. This is, in fact, where everything NVIDIA does begins.
It's become a linchpin of the global economy. Taiwan's dominance in advanced chips has grown through the AI boom, creating fortunes in the process. Local industry billionaires are 90% richer since the introduction of ChatGPT in November 2022, while stocks in Taipei have surged. Property prices hit a record high in March, with the biggest gains in the city of Hsinchu, the home of semiconductor giant TSMC. That wealth boom is raising fears some will be left behind.
There is a worsening of income distribution across the board, and I don't see any measure to improve this at the current juncture. Parents take the brunt by helping their kids, buying apartments and so on, but it's not sustainable because the next generation won't be able to do this.
Taiwan's government, though, has set ambitious growth goals, seeking a $1 trillion economy by 2028, with GDP per capita set to surpass that of South Korea next year. Abdrn, Bloomberg News.
OK, let's talk more broadly about the tech sector and bring in Jamie Mills O'Brien, Investment Director for Global and Technology Equities at Aberdeen. Jamie, thanks for coming into the studio. I want to look back at the earnings results that came out from NVIDIA last week. The earnings beat that came through for the quarter, and then the outlook that was more positive more upbeat than many estimates had suggested, and yet the stock sold off. And the take from one of our MLive strategists in-house here at Bloomberg was that signals that the AI bubble, as he characterised it, is now starting to lose air, is now starting to show signs of fragility. Would you agree with that? What did you take from those earnings, and how does that position you and your thinking going forward?
Yeah, it's a good question. I firstly challenge whether it is a bubble. I think what we've seen has been fundamentals driven rather than valuation driven, which isn't typically characteristic of a bubble. I think it is fair to say that the earnings season for tech in general has been mixed, and Nvidia probably fell into that bucket where you had good revenue but kind of around the edges, weakness in margins, particularly gross margins. And in the context of a really strong run up through the year, those kind of misses on gross margin are going to be punished. And I think there is a bigger story at play, which is fundamentals have been driving the tech sector. And if you look out into next year and the year after that, the delta or the difference between technology earnings and the rest of the market, it does start to converge. And we think that starts to matter as you go into next year and the years after that.
So how do you invest around that convergence then, in terms of big tech and the rest of the equity market? How do you position around that?
Yeah, so I think that there's two things. So I think within tech, it's very much a case of where do we see those kind of second and third derivative plays, both inside the data center and outside the data center.
Is it too early to be looking for those second and third derivatives, or is now the time?
We don't think so at all. So I think particularly in the industrial space, outside of the data center, as you move from GPU clusters, 300,000 to 1 million, kind of the way that these data center architectures are put together, the way that data center cooling is done, the impact on the grid, we think these are all quite investable themes. I think inside the data center, you've seen in the last 5 years, you've seen GPUs see kind of a 5x improvement in performance. All these GPUs need to be linked together, and the networking around that does that, and that's only seen kind of a 4x improvement. And so those roadblocks are typically quite good places to invest in tech, and there are lots of investment opportunities inside the data center, investing in things like networking, memories, another big roadblock, storage as well. So those are all big themes for us that we can invest in around the AI space.
Is that based on the assumption that huge CapEx spending, around $200 billion from some of the hyperscalers this year, that CapEx spending will continue even as those question marks become more prominent around monetization? That CapEx spending continues into 2025, through 2025, and how fundamental is that view underpinning your broader take in terms of those second and third derivative effects?
Yeah, I mean, it's absolutely fundamental. I mean, though hyperscalers are kind of 50% of Nvidia earnings, I think what we have seen in 2Q earnings is this divergence between investors increasingly questioning the ROI. I don't think that's the right question to ask, and management teams saying this is existential. We must invest in this regardless of returns. And you've had them sat here and others in various ways saying the risk of underinvestment here is far greater than the risk of overinvestment. Now, to your question, that does introduce the risk. Next year, I think visibility is very good. The year after that, the history of semiconductors suggests that you do get these digestion periods. And in the future, that is reasonably likely as you get those periods. But certainly what the market is saying, or what these CEOs are saying, is we are going to continue to invest. And if you look at CapEx forecast into next year, there's a strong move up again in CapEx. And the problem here is not demand. The problem so far has been supply, which again that was one of the good things about Nvidia results, which is that both on the supply side, both on Blackwell, which has been a big concern for the market, it was quite strong in the commentary, and also on the CoWoS supply, so on that kind of TSMC supply that's been a big problem. That also seemed quite positive.
Okay, that's really interesting. So you have that visibility into and through 2025. 2026 becomes a little bit more hazy, maybe. You touched on the grid upgrade because, of course, the energy component in this is really crucial given the demand for these data centers. How are you thinking more specifically about investing around the grid upgrade that is going to have to happen to support this technology?
Yeah, so first I think it's a global phenomenon, so you can invest globally. It's not just in the United States around this. So the industrial space in particular is quite interesting. I mean, if you look at things like new data center architectures, you're having problems around kind of GPUs melting. And that's hugely problematic on what are very, very expensive data centers. And so particularly in Taiwan, I was in Taiwan a few months ago, in the industrial space, you're getting new data center cooling solutions. So you're moving from something called air cooling to liquid cooling. That's really interesting. And then on the grid itself, there's estimates out there that are pretty punchy, but the US is expected to add something like the electricity consumption of Spain to its grid. Now, in the US, with an extremely old, underinvested utilities infrastructure, that's problematic. And so you've got this double whammy of reshoring, where that's prompting a rebuild of the capital base in the US, alongside AI coming along and putting even more pressure on the utilities space. So there's kind of this double whammy on that part. Industrials have a role to play on the cooling side, but also how these data centers are all linked up. You're seeing far more geographical concentration in data centers as well. The grid isn't really set up for that. So you're seeing kind of more concentration in parts of the US, parts of Europe as well. So there's a lot of kind of re-architecting that needs to be done, which is going to take 5-10 years.
OK, really fascinating. GPUs melting. Yeah, you can imagine there'd be some pretty miffed executives if that's happening on a wide scale. So some air cooling to liquid cooling. And the visibility in terms of the CapEx spend around 2025, a little bit more challenging maybe into 2026. Jamie Mills, really fascinating. Jamie Mills O'Brien from Aberdeen, of course, Investment Director for Global and Technology Equities. We appreciate the insights this Tuesday morning. There's plenty more coming up. Stay with us. We're going to set you up for the day-to-day ahead, including an eye on manufacturing out of the US. This is Bloomberg. Welcome back to Bloomberg Daybreak. Now brace yourselves, because September historically, we're on the third day of course of the month, has historically been a challenging month, particularly over the last 4 years for equities. In fact, if you go back to the 1950s, the Dow Jones and the S&P has seen their biggest percentage drops in the month of September. That's a historical reference point. Maybe, though, the Federal Reserve will ride to the rescue with expectations, of course, that they will cut on September the 18th. So it could be a different September, but that's just the backdrop in terms of how you prepare. It's also been a pretty bad month historically for bonds and gold as well. But talking of the Federal Reserve, let's flip the board and have a look at what to expect from the manufacturing data out of the US. The PMI manufacturing data dropping later today. The importance of that data as we lead up, of course, to the build out of the picture around the labour market of the US, with non-farm payrolls, of course, ending on Friday and giving us that key data point. But before we get there, it's manufacturing PMI, and you're expected to see a further contraction. In fact, a second straight month of contraction. 48 is the expected point when it comes to manufacturing. The data later today, and we've seen that divergence in the US, as we've seen in Europe as well, between manufacturing and services. That divergence is expected to expand further. But again, in terms of the data point, if you lift the hood, there'll also be scrutiny of new orders, of inventories, and of course of hiring as well. So manufacturing PMI out of the US later today, really, really important as well in terms of building out our views on the health of the US economy before we get the labour data in terms of ADPs later this week, and then non-farm payrolls on Friday. There is plenty more coming up. Stay with us. It is the opening trade in the next minute or so. Going to be speaking to a number of executives and a deep dive on these markets, setting you up for the week. Stay with us. This is Bloomberg.